5 seconds to the open. Ready?
Who wants to get this thing started right about now?
Welcome to Follow the Money Weekly with your host, Jerry Robinson.
Welcome.
Not just some guru.
Oh, really?
Your host is an economist and a best-selling author.
What an interesting news item. I'd better write that down.
And just someone who likes to make money and help you to make money. Welcome to Follow the Money Weekly. And here he is, Jerry Robinson.
All right, friends, welcome to this episode of the Follow the Money podcast. I'm your host, Jerry Robinson, founder here at followthemoney.com, economist, investor, and longtime trader. Great to be here today, and we have a great show lined up for you today. Today's episode is entitled Crypto Under Pressure. Is this time to panic or is it opportunity? That's really what we're going to be looking at today. You know, the market has been shaking a little bit lately. Obviously, as we look at the last couple of days, I'm recording this podcast episode on Wednesday morning, the 5th of November. And just over the last few days, we've seen the markets quaking a bit, right? Not just in crypto, but specifically, we saw Bitcoin, for example, slip back below that key $100,000 level for the first time in several months. This week, we saw Ethereum under pressure, slipping all the way down. The lowest I saw it get was around $3,200. Now, that came down, of course, way from its all-time high around $4,900 not too long ago. So we've had a lot of volatility there. Altcoins like Chainlink and BitTensor, these are also experiencing a lot of volatility. But when you step back, you notice that we're not really just dealing with a crypto correction. We've really kind of moved into a full-blown risk-off place when it comes to crypto. And it makes you wonder, is the 4-year cycle still intact? Have we come to the end of the cycle? Is that what's happening here? Also, take a look at stocks. Stocks have been a bit wobbly. We've had some great moves in stocks. They're still in a big uptrend, but we are starting to notice some, wobbly price action. Gold has certainly come off of its highs, and the bubble chatter is really starting to echo through the headlines again. If you look at Google Trends, for example, you'll notice that many retail investors, at least that's what we can assume, are Googling, are we in a bubble, right? So we got the Fed walking a tightrope on rate cuts. We got a government shutdown dragging on. It's the longest ever in U.S. history. And then tariffs, continue to bite American manufacturers. So today, we're going to briefly just zoom out and try to make sense of what's going on. We'll try to figure out what's really driving this sell-off. What does it mean specifically for crypto investors, and how should disciplined traders and investors be thinking in moments of like this? Because if you're in the crypto market right now, it's corrections like these that test your patience, but they also reveal who's playing the long game and who is really just reacting to noise. Let's get started. All right, let's begin with what's happening out there, because it's not really just crypto that's under pressure right now. Let's put this sell-off in context. Bitcoin, as I mentioned, recently slipped below the $100,000 level for the first time since June, right? We saw it come down. It actually tested that 50 weekly moving average that I've been talking to our members about. And now, as we look at it now, it's just hovering right at that area. This is a key support level for Bitcoin. It's kind of make or break time for this current trend. So we're watching Bitcoin very closely right now, right at that 50 weekly moving average, a very important level that we're watching. And by the way, that 50 weekly moving average currently on Bitcoin as of this recording is around 103,000. So again, that's the level I've been targeting and telling our members about. Right now, as I record this, Bitcoin has regained some of its losses, kind of recouped some of those losses. It's back up around 103,600 or so as I record this. So it's definitely off of its lows. It got down, as low as, say, 99,000 over the last 24 hours or so. So it is rebounding. It's trying to hold that 50 weekly moving average. So if you're watching Bitcoin, that's an area that I would encourage you to look at. Just get a stock chart, whether you're using stockcharts.com or TradingView, or you're using our profit tracker software, whatever you're using, or even your own brokerage firm charting. Just put in a weekly chart with Bitcoin and apply a 50 moving average to the weekly chart, and you'll see that line. That line has consistently held during this rally. And so we want to see how Bitcoin reacts here. This could actually be a great opportunity to add more right here because you don't get this pullback very often to this level in an uptrend. The question is the uptrend still intact? Are we coming to the end of the uptrend, right? So that's the key. So, and really, how we react around this area may be very telling to that question. We also take a look, for example, at Ethereum. Ethereum has also pulled back sharply. Again, the 50 weekly moving average on Ethereum is also a key area to watch as well. That area right now currently around 3150. Right now, Ethereum is trading off of its lows, which got down near 3,000 over the last 24 hours. It's up around 3,400 now as we speak in this recording. So again, watching that same moving average on Ethereum, I think would be pretty smart right about now, just to pay attention to see how things are going to turn out. It's difficult to know, of course. And the other key area for Ethereum is around the 20, I would say right around the 2750 area. That also is an area that's had a lot of kind of battle-tested area. I don't see us coming down to that level necessarily right now, but if the sell-off continues, we sure could see that area. So first line of defense right there at that 50 weekly moving average for Ethereum, then 2750 would really be the next area I'd be watching. You also got names like Chainlink and Solana, both of which we own. We own Bitcoin, we own Ethereum, we own Chainlink, we own Solana. All of these, in fact, Chainlink and Solana have been pretty hot lately, but they've been giving back a lot of their gains. So after such a strong run that we've seen over the last, many months, not just 2025, we've come off those lows, but that we were at back in 2022, 2023. It's not surprising to see the market going through some volatility. But as I mentioned, it's not just a crypto story this week, right? We've been seeing some weakness across the board. Gold and silver, for example, which had an incredible rally. We've been, just tracking that rally for many months for our members and even talking about it right here on this podcast. But gold and silver have really, both come off of their highs. Gold, came off of that 4350 level or so. And, that area just now looks like we're going to have some resistance at that level because we have those long upper wicks. It may take some time. We may even see gold come back down and consolidate, even in the 3,600 level or so. It could even pull back that far. I don't necessarily think that the rally in gold is over because the fundamentals really haven't changed that drove gold up in the first place, right? The same thing with silver. We've also seen the NASDAQ come under some pressure recently. Not huge pressure. In fact, it's really been pretty minor. But nonetheless, there are some concerns and fears in the market about whether or not, we are in a bubble, right? And even the S&P, has been taking a moment to catch its breath after recently hitting some record levels. So, part of this that's happening, what we're seeing right now, part of it is simple profit taking, right? You've always got to include that. If people are fearful about the future, they may take profits. And that's certainly what we've seen in the crypto market partially, right? Part of it is also the fact that the U.S. dollar has begun to strengthen lately. A few weeks ago, we put out an alert to our members that the U.S. dollar had formed a new position uptrend for the first time in a bit because it had been coming down for most of the year. That resurgent dollar can put pressure on risk assets. And that's also part of what's happening here. Another part, as I mentioned, is the sentiment. There's that growing narrative that we are in a bubble, an AI bubble, right? And nobody wants to be, the last man, buying in the bubble. So we understand that also is kind of spooking some investors. Over the last few weeks, in fact, talk of a bubble, especially in tech and the AI stocks, has really kind of exploded. We've seen headlines from Goldman Sachs' David Solomon. He's warning about a potential double-digit correction because of the froth in the market. Morgan Stanley's Ted Pick said that pretty much the same thing. Then you had Michael Burry of the Big Short fame, who recently unveiled that he actually revealed a bearish position against Palantir and NVIDIA, putting 60 to 80% of his portfolio in short positions against these stocks. Even Kathy Wood from ARK Invest reportedly sold a bunch of shares of Palantir right before earnings, right? So you can tell there's a little nervousness in the market, and you can tell from some of the people who are making comments, right? Also, the fact that the Fed has also kind of changed the trajectory a little bit, at least in some investors' minds, of what the rate cuts are going to look like going forward. That also could be pressuring the markets, right? So you have this kind of chatter that's going on that's stirring emotions. The market is reacting as it normally does. And everyone, starts to wonder if the bubble has popped. But let me just say this. I think we need to slow down and actually look at what's happening. Take a look, for example, at the S&P 500's PE ratio. That's a very important number that it's useful to track to know where we are historically speaking. And right now, the S&P's PE ratio is right around 30. Okay. Now that is well below the dot-com peak near 46, and it's nowhere near the extremes that we saw, back in, right before the 2008 crash, right? And unlike the early 2000s, today's big tech companies like Apple and Microsoft and Nvidia, they're massively profitable. Right, they're sitting on fortress balance sheets and they're generating real solid earnings and real strong revenue growth. So, it's wrong to say that this is some sort of mania that's built upon vaporware and that, we're all going to see these asset prices collapse. I think that's a wrong way to look at it. We're not even there historically in terms of the PE ratio on the S&P. Even in this crypto market sell-off that we're seeing, this sell-off looks more like a rotation than a collapse. I mean, if you look at Bitcoin, it still remains up, year to date, even with the sell-off. Ethereum's network continues to expand, even though it's, fighting to be flat for the year. And projects like Chainlink and BitTensor, two of my favorite altcoins, are building real infrastructure for the next wave of decentralized innovation. So what I think we're seeing right now, quite frankly, is more about macro headwinds than any real weakness in the fundamentals undergirding the many of these companies and many of these projects. Okay, case in point was Jerome Powell's comments last week at the Federal Reserve meeting, the policy meeting where they decided for the second time in 2025 to cut rates by 25 basis points. But Powell was very clear that he did not want investors to assume that the next rate cut was baked into the cake, right? And that altered some perceptions among investors. And if you look at the Fed futures market right now, the expectation is a 25 basis point cut in December, a 70% chance or so last time I looked. So the market still expects it, but Powell was trying to pump the brakes, and I think that also cooled some expectations for a guaranteed December rate cut. I still think it's coming, but the Fed's comments there also kind of jarred some investors. So too, the Trump administration's tariff battles are heating up again. Right now, this week, the Supreme Court is reviewing the tariffs that Trump has placed on the world for all intents and purposes. And three court rulings have already deemed these tariffs by Trump to be illegal, to be unconstitutional. And now the Supreme Court has decided to weigh in on this, and it's going to be reviewed by the Supreme Court this week. Now, they have until June to release their ruling on it. That's a long time from now, when you think about it. But the expectation is that they're very likely going to reveal their ruling by January. I mean, it's a very important ruling, so they can't just sit on it. So that right there, if we get a Supreme Court ruling that finds that the tariffs are unconstitutional, my guess is that you're going to see a massive reset in valuations, and it could be a face-ripping melt up as risk gets repriced. So that is something to be very, very watchful about. Probably by January, we'll have a clue as to what the Supreme Court's going to do with these tariffs. If they leave them intact, that could be a very interesting outcome as well. But if they overrule them, and they have many ways to do this, by the way, that could also really help aid the market, because many companies have been talking about the difficulty with these tariffs. And so you have the government shutdown still dragging on, right? The longest one in history. That's pressuring the market. It's pressuring many investment theses. I mean, when you look, for example, at the money that the government puts out, and then you just shut it down. I mean, that obviously is dragging on sentiment. It's dragging on the economy. You also have still some fears over in the regional banking industry after more fraud headlines. So there's concern there about faulty loans and risky loans and things like that in the regional bank industry. Top it all off, the latest ISM manufacturing report showed that U.S. factories contracted for the 8th month in a row. Okay, that's really tough. And that ISM is a very important figure when you're looking for risk on assets to go, that kind of environment where you want to see asset prices go higher. So right now, corporate executives are frustrated in many different industries. Some are complaining that steel tariffs are killing them. Others that their profits are under pressure because of these tariffs. So business just continues to be, pretty depressed in various areas. And that's not the kind of data that's going to breed confidence in the short term, right? So obviously, the market feels fragile right now. But fragility, let me stress this. Fragility is not the same thing as a bubble. What's happening is that fear is just replacing greed, right? At least temporarily. Investors are searching for certainty in a very uncertain environment. So obviously, they're going to take some chips off the table. They're going to raise some cash. They're going to wait for more clarity on interest rates and on tariffs and on all of these things. But if you look at earnings, for example, in the corporate world, in the markets, we've seen some killer earnings reports, this quarter, and it's been a really good one. So in other words, I think all of this is kind of a healthy reset. It's the market doing what it always does when optimism just gets a little overboard. So I would tell you that if you ask me, are we in a bubble? I would say that we are currently inflating a bubble, but I would not say we're in danger of the bubble bursting now, right? I see that we'll probably have several more years ahead before we run into major trouble. And I think we will. I think there'll be massive over leverage. This may be one of the biggest bubbles that we've ever seen that will eventually burst, okay? But I don't see that now. Based on all the data that I have, I think there's a lot of fear, but I don't think that fear really has a lot of foundation quite yet. I think the case can be made over the next few years if we continue on this track that a real bubble will be something that we need to be concerned about. But as of right now, I see that we still have more time ahead. I think instead of viewing this as a crisis right now, we should see it as an opportunity. So when we come back, I'm going to talk about how disciplined traders and patient investors can navigate in times like this. Volatility doesn't have to shake you out. In fact, it should be preparing you for the next opportunity. I'll see you on the other side with those thoughts. Hey friends, this is Jerry Robinson from Follow the Money Weekly. Recently, we have been receiving many emails from our listeners commenting on the great help they're getting from our precious metals expert, Tom Cloud. Gold and silver are excellent hedges against the growing threat of coming U.S. inflation. Who's your gold guy? Make it Tom Cloud. With over 30 years experience with precious metals, Tom will answer all of your questions. Don't buy your gold and silver through some call center and pay inflated prices. Call my good friend Tom Cloud and speak directly with him and get all of your questions answered. For a limited time, Tom is offering free shipping and insurance on every gold and silver purchase made by our listeners. Call 800-247-2812. And when you do, tell him that Jerry Robinson from Follow the Money Weekly sent you, and he'll throw in that free shipping and insurance on your entire order. Call your gold guy, Tom Cloud, right now for the very best deals on gold and silver coins. 800-247-2812. That is 800-247-2812.
Welcome back to Follow the Money Weekly. And here's Jerry Robinson.
Welcome back to the program, friends. You're listening to the Follow the Money podcast, one of the longest running podcasts focused on personal finance anywhere. We've been doing it since 2010. You can find us online at followthemoney.com. So now, how should we respond when markets start acting like this, right? When crypto has a meltdown like we've seen over the last 48 hours or so, and when stocks pull back sharply and the media starts going into panic mode about a bubble, how do we handle this? What are you supposed to do with this? Well, I think the answer is pretty simple, and our members have been hearing me talk about this for a long time. But for those out there, if you got on social media, for example, the last couple of days, or you've just listened to some of the headlines around crypto, it's just been hair on fire kind of replies, right? Kind of responses. If you've been following me for any length of time, you already know my rules for investing, especially when it comes to things that are high volatility like crypto, right? You never, ever invest more than you can afford to lose, right? This is one of the key tenets, and many people just don't know. I don't think they learn it. They certainly don't teach it in school. But when it comes to things like cryptocurrency, I've been investing in cryptocurrency for well over a decade. I've been investing in, as I mentioned, I like Bitcoin, I like Ethereum, I like Chainlink, I like BitTensor. There's several and other projects. You can see my entire portfolio on our website, followthemoney.com/cryptocurrency-portfolio. That's a member benefit. But if you've been following me for any length of time, you know that I've been saying that for a long time. You should never invest more than you can afford to lose. That goes for anything, right? So for many people, they got too heavily into a very risky asset. And so then when it goes down, right, they start, feeling the pain. Well, that makes sense, right? If you put more in than you could afford to lose. Another lesson that I've taught for a long time is to avoid leverage. Many people who got caught up in the recent sell-off in crypto were over-leveraged. They were borrowing money to buy a risky asset. Again, I teach that you should not use leverage when it comes to these kinds of assets, right? Another rule that we teach is that you don't chase green candles out of fear of missing out. How many people just chase green candles when they go up? And then, when it turns around, they act as if somebody's manipulating the system or something like that. No, you got caught up in fear of missing out and greed. And then when it comes back down on you, well, that's kind of what you should expect, right? Another lesson that I teach regarding cryptocurrency is that you should self-custody your coins at all times. So you always want to be self-custodying. If you don't know what that means, you really need to become a member here at Follow the Money. We'll teach you how to be a savvy cryptocurrency investor. We teach you all of the rules that we use, and we show you. We have videos and videos and videos, instructional videos teaching you how to be a smart crypto investor and how to self-custody your own coins. We also teach that you should adopt a long-term approach when it comes to cryptocurrency, right? So these sell-offs like this shouldn't really deter you if you have a long-term view. I mean, let's be honest. Digital assets are part of the future. This is a new asset class that is gaining legitimacy each and every day. And over the next 5 to 10 years, we're going to see a lot happen in this space. But I would suggest to you that the prices that we see now are going to be much higher 5, 10, 20 years from now, right? And you have to view it that way. Most people live in the moment. They think about right now, and they want 100% gains right now. You're going to set yourself up for failure if you view it that way, right? So you really want to hodl. As they say, hodl, hodl for the long term. You need to ignore the noise, right? Turn off the social media. Turn off the financial media. They're not really there to help you, by the way. They're there just to spout what they think, and it's all really rooted in emotion. Not a whole lot of logic there. So you really want to ignore the noise, and you really need to be expecting massive volatility all along the way, right? You shouldn't expect that you're invested in some sort of bond or something like that. You're dealing with a cryptocurrency. You're dealing with a burgeoning asset class that you should expect to go up and down and up and down, right? You should expect serious declines, and you should expect along the way some pretty huge rallies, right? That's what we're in here with cryptocurrency. So don't invest in more than you can afford to lose. Don't use leverage. Don't chase green candles, out of fear of missing out. Always self-custody your coins. Ignore the noise. Hold for the long term and expect massive volatility all along the way. I mean, this is kind of sums up the idea here. Now, if you can do those things consistently, then you're going to avoid most of the pain that wipes out emotional investors. That goes, by the way, the same goes for the stock market. So you don't panic when headlines turn bearish. You don't sell quality positions just because the crowd gets nervous, right? Instead, you take a step back. You remember your time horizon. You remember your own rules. You look at the data, right? And right now, when you do that, you'll see that the fundamentals haven't broken down. Not in crypto, not in equities. The S&P 500's valuation remains far below the dot-com era. Earnings continue to beat expectations in a very strong way, right? The recession odds have fallen sharply all year long. And in crypto, Bitcoin's adoption curve continues to climb sharply. Ethereum's ecosystem is expanding every day. Long-term holders are continuing to accumulate. They're not selling. So this sell-off is uncomfortable, yes, but it's normal. Corrections clear excess. They clear out the weak hands in the market. There's lots of speculators who, kind of hop on and because of FOMO, but they'll get shaken out whenever we have a sell-off. But what that does is it clears the excess and it resets the opportunity for people like you and I who want to take advantage of it. So I was buying cryptocurrency yesterday. I blasted out an email to all of our platinum members. I put it on our private Twitter feed. I'm buying these 4 cryptocurrencies. Did that yesterday. Took advantage of the sell-off. See, what I like to do is buy on big red, big down days, right? And then to sell a little, to trim a little of my gains in really big up markets. That's how it works, right? Most investors or traders, they do it the exact opposite, right? They'll start selling whenever it's red, and then they'll buy whenever it's green, and they're ended up buying at the tops and selling at the bottoms, right? Not a good idea. So when fear rises up, disciplined investors just quietly, assess the situation. They may tighten their stops if they're using stop losses. They may reduce their position size if they feel like they're overextended. They're also going to be looking for new entries, though, when the crowd overreacts. In other words, they use volatility. They don't get used by it, right? And let's be honest, volatility is the price of admission for higher returns. You don't get the upside of innovation without the temporary chaos that comes right along with it. That's true for crypto, that's true for stocks, and for every bull market in history. Now, when we come back, I'll wrap things up with a quick final word. I'll see you on the other side of this break. All right, friends, welcome back to the final moments of today's broadcast. And I just want to end this broadcast by saying this, that when the market gets noisy, like we've seen over the last few days, it's easy to lose perspective, right? Very easy. Headlines start to scream about bubbles and charts turn red and fear begins to spread. But this is when it's most important for you to learn how to separate the noise from the signal. You see, the noise is the daily drama. It's the opinions. It's the predictions. It's the panic. The signal is the trend. It's the data. It's your discipline. And so when we see Bitcoin falling sharply, we see Ethereum falling, we don't necessarily think to ourselves, okay, that means that the entire digital asset space is done forever. Right? No. Just as a few weak manufacturing reports don't erase the strength of America's largest and most solvent companies, what matters is the bigger picture and whether your actions align with your strategy, with your plan. See, the market's job is to test your conviction, and your job is to stay grounded in a well-formed strategy that is rooted in time-tested truths, not emotion. So my strong advice to all of our listeners today is to turn down the noise and to turn up that signal, right? Focus on what you can measure. Remember that opportunity does not disappear simply when prices go down. In fact, the opportunity is there. It's just hiding from those who are impatient. Because like every correction before this too shall pass. Friends, my name is Jerry Robinson, founder here at followthemoney.com. You've been listening to the Follow the Money podcast. Thank you so much for joining me today. Stay focused and stay disciplined. Remember, when you want the truth, just follow the money. Have a safe and prosperous week, and I'll see you right back here next time. Until then, God bless.
is strictly for informational and educational purposes. It should not be construed as specific investment advice. The views and opinions of our guests and sponsors, including Tom Cloud, are their own and do not necessarily represent the views of FTMDaily.com or Robinson Media Group, LLC. Jerry Robinson does hold an insurance license and at times may offer consulting on life insurance and fixed retirement income products. Follow-up, individualized responses to email or phone requests that involve the rendering of personalized investment advice for compensation will not be made absent compliance with state investment advisor registration requirements or an applicable exemption or exclusion and applicable insurance regulations. Past performance is not indicative of future results. You should be aware of the real risk of loss in following any strategy or investment discussed on the podcast. Remember, never do your financial planning through podcast or radio. It's your money. Be wise. Do your due diligence and always consult a trusted financial professional before making any financial decisions.